Welcome, everybody, to another one of our Influencer Strategist sessions. My name is Gordon Glenister, and I'm one of the co founders of Influencer Strategists, which is a global community of some of the very best influencer marketeers from platforms, agencies, and brands. And today I have with me James Creech, who is the founder of Quartermast Advisors and one of our esteemed members. James, it's so nice to have you with us on this session today, and I'm really looking forward to it.
Thank you. Me too. Thanks for having me.
Yeah. Just before we get into our subject matter, which is going to be all about sort of mergers and acquisitions in the
Mhm.
creator economy, I was sort of fascinated to find out why you called the company Quartermast, and
Sure.
it certainly amused me when you told me why.
Yeah. So we are an M&A advisory firm focused on digital media tech and the creator economy. And the name comes from, many people probably know Q and James Bond, right? Who supplies all the gadgets and fun tech for the agents. And so that actually is short for quartermaster, which is a position in the military who's responsible for the inventory and the provisions. And so we think of ourselves as kind of the right hand of the founders and entrepreneurs that we work with. And so that's where the name comes from.
Yeah. Wonderful, love it, great. So, just a reminder to anybody that wants to sort of ask any questions or please use the chat. And after James has sort of shared his insights and thoughts around the creator economy for the next sort of 20 minutes or so, I'm going to go through some of those questions with him as well as my own ones. So please do that. So James, really over to you. Tell us about what's going on. And I think Sebastian, who's the technical behind the scenes here, is going to put up the slides for us.
Terrific. Yeah, as Gordon mentioned, we'll run through these slides real quick, kind of give an overview of what's going on in the creator economy, especially from a creator capital landscape and an M&A perspective. But I welcome your questions. It's way more fun to get to dive into that and make it more interactive. So please feel free to drop them in the chat as we go along, and we'll talk more at the end. So as a bit of background, right, I've been in the creator economy for about 15 years, worked in some early stage startups, then started my first business with two co-founders, a company called Paladin, which was influencer marketing software. So I have a lot of love and affinity for the influencer space, having spent quite a bit of time in it. Saw a lot of the challenges firsthand at early creator networks and agencies trying to run campaigns, and it was time consuming, tedious, right? A lot of manual processes to find influencers, manage their workflows, report on a campaign performance. And so we started building some software to make it easier. Fast forward 6 years, sold that business to Brandwatch, which is a big social listening software business. Spent some time integrating the acquisition into Brandwatch and working on some strategy and M&A projects for our parent company, Cision. But I had a lot of founder friends who reached out and said, hey, what did you learn going through the process? What was your experience like? And oh, by the way, could you help us sell our company? We've been thinking about doing the same thing. So started just supporting a few friends on nights and weekends and fell in love with it. Really enjoyed getting to help founders navigate what is one of the most exciting, but also challenging and critical aspects of your professional journey. So we support with everything from getting organized to finding the buyers to negotiating and structuring the transaction, getting you through due diligence, and then getting a deal over the finish line. So it's a long process, about 9 to 12 months on average, but it's really rewarding and it kind of builds on my experience being in the space for a long time. So for context today, I wanted to share some statistics. Our firm puts out a lot of research and these kind of annual reports looking at the M&A activity in our space, which is a helpful lens into the maturity of the creator economy and how buyers who are both native and outside of the space are looking at the growth and the economic opportunity that this landscape offers. So this report kind of breaks down all of the 2025 transactions, basically all the mergers and acquisition activity that happened last year. It's included in a report, so I've got a lot of helpful statistics in here. We can share the slides. I'm happy to share the report. There's a lot of really interesting data in here, but that's the backdrop for the presentation. And then I'll start to tease a little bit about some of the things we're already seeing in Q1 of 2026. But this is based on last year's data. So we saw 81 M&A deals last year, which was a record, right? So up 17% year over year. It's the most transaction volume we've ever seen. By the way, this year is already on pace to break that record. Q1 has been extremely busy, and I think we are on track to do over 100 transactions in 2026. Most of the activity happens in North America. That's both targets, so the companies that are being acquired, as well as buyers. We're certainly seeing a lot happen in Europe and Asia and emerging markets, but North America still leads the way. And then in terms of acquisition targets, we'll break this down in a future slide, but it's heavily software based. Then there's media properties, services businesses. We'll dig into that. And then finally, valuations, right? Like, how are these businesses evaluated? How does a buyer place a value on a company? And then, looking at the global creator economy market, right? We're operating in this global ecosystem. It's $235 billion this year. I did a LinkedIn post about this recently, putting it in perspective. That's bigger than, box office television. Theatrical box office. It's bigger than video games. It's bigger than, theme parks. There's a lot of traditional legacy media businesses that are enormous markets, but the creator economy has grown to such a massive impact that it's really interesting to see how much of a global phenomenon this has become. And it's growing really quickly, right? This compound annual growth rate of 22.5%, meaning it's a big space and it's only getting bigger. This is a reflection of the M&A volume, right, over the years. So as we saw 81 deals last year, we saw, pretty significant spike in COVID. The pandemic really accelerated the deal volume as more people are spending time online, more activity is flowing into digital businesses. This is an influencer marketing group. So what's kind of keenly interesting about this period is there was a huge uptick in influencer marketing acquisitions, agencies, SaaS platforms, marketplaces. But in general, the creator economy has continued to grow over the past few years. And like I said, we're already on track for a very strong 2026. If we look at it based on quarterly activity, kind of an unusual pattern emerged at least last year, right? Like, we tend to see a lot of announcements in Q1, which can sometimes be hangover from deals that, ended up getting finalized around the holidays, but then get announced in January. So we definitely see some of that behavior. Typically, you'll also see a lot of deal activity in Q3, but surprisingly less last year. And maybe that's why, some of these transactions just took a little longer and ended up getting announced this year. But yes, we had a stronger kind of H1 and a lower H2. And this year we'll see how the trend plays out. But we've had already a very, very active Q1 that's beating these forecasts. This is a snapshot of the largest transactions last year, right? So we had Vimeo going private to Bending Spoons, which is this Italian tech conglomerate. Later, influencer marketing and social media management tool buying Mavely, getting into social commerce. Publicis being extremely acquisitive, right? Captivate, BR Media Group in Brazil, strengthening both its geographical footprint as well as its technical capabilities. And then finally, Wonder purchasing Tastemade, which is an interesting example of a non-endemic company kind of coming in and acquiring a creator economy brand. Target profiles, right? This is the types of companies that are getting acquired. So software leads the way with almost 26% of the acquisitions, followed by agencies, media properties, talent management businesses, audio, so like podcasting and music, creator networks, and then the other categories, things like creator infrastructure, other types of tools. Some interesting observations here, at least as it relates to influencer marketing, is that a lot of these agencies are influencer marketing agencies, right? There's been an enormous amount of consolidation, primarily being driven by traditional agencies, social agencies, digital agencies, wanting creator economy capabilities, wanting this creator marketing expertise and DNA in-house, and they're going out and they're buying kind of small and mid-sized influencer agencies. So we expect that trend will continue. The influencer landscape is still pretty fragmented, and there's enormous opportunity here. So we're seeing more consolidation, both among agencies as well as talent representation businesses. Geographic distribution. So, this year, kind of stayed true to theme in that we still see most of the deals happening in North America and principally in the US. Europe in second place. We saw a decline in 2025 in terms of the number of acquisitions coming out of Asia. It looks like my graphic got moved. This should be Australasia, but in any event, we suspect that this year we'll see more cross-border transactions, and we're actually also expecting to see more deal volume out of Europe and out of Asia. Valuation multiples, right? This is every founder's favorite question. What is my business worth? And the way to think about that, right, is if it's a software business, they tend to trade off a multiple of recurring revenue, right? So annual recurring revenue, if it's SaaS, there are some other kind of business models in software that can affect your valuation, but in general, it's like, what is the repeatable recurring revenue that you generate? And they would trade for about 3.2 to 10.7 is the broad range. 5.8 is the median value. So most companies, if you have kind of standard metrics, would expect to fall within this range. Now, there are things that would place you on the low end or the high end of the range. That can be risk factors, growth rate, historical business performance. And there are things that can put you above the range, right? So if you are especially strategic to a particular buyer, or you've got, incredibly impressive growth or other metrics that can help justify a premium, right? But this gives you a sense of where most of these deals tend to fall. And then when it comes to services, businesses, media properties, they're evaluated based on EBITDA, right? Which is essentially a financial proxy for the future profitability of the business, right? So what are the expected kind of free cash flows? What is this business going to generate going forward? And, broadly, these businesses kind of trade for 4 to 9 times. A lot of the median values tend to fall around like 6 to 7. So a healthy business should expect to fetch that type of valuation. Now, there can always be structure to a deal, so you might not get all of that up front. Oftentimes when we see like an influencer marketing agency get acquired, there's a good amount of consideration payable at closing, but then there's also some sort of contingent consideration, which usually means like an earnout. So they have performance-based targets that they have to hit. There could be an equity rollover component. There could be a deferred consideration element. But all this to say, the expected value of the business tends to fall within these ranges. And people always have questions about valuations. I love this stuff. Happy to geek out on it and dig in further in the Q&A. Buyer archetypes, right? Who are the types of companies that are interested in the creator economy and are buying these types of businesses? Well, every deal is different. There are certainly repeat buyers who are very active, but there's also a vast number of buyers. And so we're seeing them be these kind of traditional agency groups, whether they are the large holdcos or more of these independent agencies, or even some of the private equity-backed agency roll-up plays. You've got audio buyers that are especially busy in music and podcasting, tech platforms, which can be creator economy native, or more MarTech incumbents that are acquisitive. Talent agencies have placed some bets here. Media and entertainment companies are, of course, going through their own phase of consolidation, but also still buying kind of new media, digital media, creator economy properties. The private equity activity is really interesting because this signals that there's new professional capital coming into the ecosystem. People tend to think of private equity buyers as economic rather than strategic acquirers, meaning, they're looking to do some financial engineering, find ways to extract value and make a good return on these businesses. But that's not always the case. Like there certainly are those archetypes of economic buyers, but you also have some pretty strategic private equity plays that see the value in the long-term potential of the creator economy, and increasingly actually a lot of like growth equity investments. So they'll do a deal where they'll buy a majority stake in a business, anywhere from like 51 to 80%. And then that infusion of cash provides some secondary, so some liquidity for founders or earlier investors, but also gives them some growth capital. That's been the case with Later. They've certainly had this kind of private equity backed growth structure. You saw it with Uscreen, right, where I think it was PSG came in and took a majority stake and is supercharging that business. So that's an interesting kind of trend to observe. And then finally, you've got these kind of creator media roll-ups. So companies explicitly buying digital media properties or socially native kind of publishers, and are excited about kind of where this space is going. Key trends, right? So these are some of the things that we observed last year. 2025 was a record year for creator economy M&A. This year is on track to beat those results, so certainly on that same pace. Larger transaction sizes. So this is really interesting that we're starting to see, a lot of 8-figure, 9-figure transactions, even, starting to see billion-dollar opportunities in the creator economy, whether that's, something like what Mr. Beast is doing, or the trajectory that like Dude Perfect and other of these like very large creator economy companies are on. We're starting to see more unicorns come out of the creator economy. Stable demand across key segments. So this is the breakdown of what types of companies are being acquired: software versus agency versus talent representation. That was pretty consistent between 2025 and 2024. Still early to say for this year, but it's looking like there's kind of continued interest or demand across all of those categories. And last year we saw a bit of a pullback in cross-border transactions, which, maybe that's just a temporary occurrence. Maybe that's a signal that buyers want to focus more on their home markets, which could be due to regulatory or just kind of scaling challenges. But I personally think we're going to see more cross-border transactions this year. So we've got some deal breakdowns in our report. So I'll highlight a few for you here very quickly, but there's a lot more you can dig into in the reports if you're curious. The Later and Mavely acquisition was the first deal announced in 2025 and was a huge transaction, right? $250 million. Pretty exciting opportunity as Later continues to scale into social commerce. We saw Publicis acquire Captivate, merging it in with Influential as it continues to make this big push into influencer marketing. What's interesting about this is Publicis has publicly said, hey, we've got, I think it's like over 800 million euro earmarked for M&A activity. And a lot of that is going into influencer, right? It's the media deal in Brazil. They acquired Hetmill out of Southeast Asia. They are a little bit behind WPP, right, which acquired The Goat and obviously in Village Marketing, a few years ago, kind of around the COVID spike. And now Publicis is aggressively pushing into our space. I would expect Omnicom to follow suit now that the IPG merger is complete. So a lot of interest from these kind of traditional agency holdcos. And then just to highlight one of the transactions we worked on last year. So V10, which is backed by Clarion Capital, acquired Tower House, which is a creator services business. They are pushing into sports. They are leveraging Tower House's capabilities in audience development and digital rights management to supercharge their IP, which includes things like America's Funniest Videos and some other really cool digital shows. So that was a fun one to work on. Some practical tips for founders who are thinking about selling your company. Be clear about what you want, right? When you talk to potential buyers, it's important to know what's relevant for you, right? What you want to get out of the deal. So just to share my experience, right? When we were selling our company, Paladin, I was very clear that, we cared a lot about the technology that we'd built in the team. So I didn't want to go somewhere where we couldn't take the whole team. We wanted to continue to grow and invest in our team and our product. And we wanted someone who shared that vision. It was also, hey, we saw the opportunity. We wanted to kind of supercharge our commercial growth. We wanted to expand into new markets. So we wanted a partner who could help us achieve that, which we found in Brandwatch, which was great. The next tip is to prepare the business before the process. So having like very clean records and good corporate hygiene is a great way to just stay organized and make life easier. But there's also things that you might want to start to think about before you hire a deal team and start to pursue M&A. So that can be things like, hey, if we're a services business, like an agency, if we know we're going to get evaluated based on EBITDA, you want your trailing 12 months before you're acquired to be very strong from an EBITDA standpoint. So that doesn't mean you stop investing in growth or you cut expenses. It's, be very intentional about how do we show a path to growing profits and maximizing the return, both, for our shareholders as well as for the future buyer. The next tip is to create optionality, right? More buyers equals more leverage, more choice. As investment bankers or M&A advisors, that's kind of a big part of the role we play. And so that leads into my next point around surround yourself with trusted advisors. This should be experts in the field. It can be mentors. A good deal team also includes an experienced M&A lawyer and then some sort of finance professional like your CPA. Pay attention to deal structure, right? It's easy for founders to focus on the headline number and maybe the key terms, but it's also important to understand liquidation preferences and earnout structures and contingent consideration and restrictive covenants. So there's a lot of kind of devil in the details here, which again is where your advisors can come in and kind of show you, hey, this is a market term. This is where we need to negotiate or push back. But those little elements do matter. That said, don't sweat the small stuff. There are 101 things to negotiate in every deal. So don't get hung up on things that you don't really care about or might be immaterial. Like focus on things that are really important for you and your outcome. And then the last tip is stop and smell the roses, right? Like you should be really proud of what you've built. Selling a business is maybe one of the most intense and rewarding but challenging things you'll do. So make sure to enjoy the process as much as possible and celebrate the outcome in the end. Some predictions for this year: deal volume stays hot. The data already backs that up, so we're certainly seeing that reflected in everything we've seen so far in Q1. Creator-founded company exits increase. I think we're certainly going to see this both from a standpoint of people buying creator-driven media businesses, so like social accounts and media properties, but also CPG brands and creator software companies. Like there's a really cool trend of creators also becoming founders and entrepreneurs and building these impressive businesses around their audience. I expect we'll see more picks and shovels acquisitions. I personally am a big fan of infrastructure plays, right? That this is critical scaffolding for the creator economy and lets us continue to grow and build and level up what's happening in our space. These also tend to be very attractive things for buyers if you become an important part of the ecosystem. And then finally, more non-endemic buyers moving in. So yes, we've got a lot of incumbents from adjacent industries keenly interested in the creator space. That will continue. But I think we're also going to see some buyers from some less expected places. And I welcome that. I think it's a good thing that more and more people recognize the power and the long-term growth potential of our industry. So if you want to learn more, check out our Creator Economy M&A report. It's available on our website. It's free. It's almost 40 pages. There's a lot of really valuable information and context in here. We also publish a weekly newsletter called the Digital Deal Flow, which I share on LinkedIn, or you can find on our company page. It's on Beehive. And then follow us on LinkedIn, right? Either me directly or our company page, Quartermaster Advisors. We're constantly sharing data and insights and some of the learnings that we have working actively in the space. So with that, thanks so much. Let's take some questions.
Wonderful. Thank you, James. That was really, really insightful and quite fascinating. It's amazing to see how some of these big agencies are really thinking about investing so heavily. And I know you mentioned WPP and the GOAT and others. Yeah. So I can, and from a geographical point of view, it's quite amazing how that landscape is really developing, isn't it?
Mm-hmm. Absolutely. Yeah, I mean, I've always said this is a global ecosystem, and it's amazing to see when transactions are happening in other parts of the world.
Yeah. Okay, so I've got quite a few questions here. So Janan says to me, for AI first agencies in the creator economy, are you seeing any valuation premium versus traditional agencies, or are investors and buyers still largely underwriting them on standard services? To multiples and only giving credit where AI impact is proven. And then he says, more specifically, how much weight are investors placing on documented AI-driven margin improvement, and what level of evidence documentation is actually required? That's quite a long question, but anyway.
That's a very thoughtful one. Yes. So first of all, services businesses, specifically agencies, are going to be evaluated based on EBITDA. Now, that said, there are some kind of core assumptions around unit economics, specifically gross margins and net margins, that buyers and investors will look at carefully. And particularly with the advent of AI, they want to see, are you able to scale output without increasing your cost basis? In other words, Can you do more with the same amount of people? And increasingly, the answer seems to be yes, right? There are a lot of off-the-shelf AI tools that agencies are leveraging, as well as kind of custom proprietary built solutions, which can absolutely either give you a competitive advantage, which can lend itself to a strategic multiple, or demonstrate that margin improvement, which then, allows you to confidently share a future-looking forecast that says we're going to grow EBITDA more meaningfully each year because our cost basis can kind of stay the same or potentially shrink while revenues grow. So yes, I do think you can justify a tech-enabled or an AI leveraged premium. It's probably not going to be massive, right? But if there is an uplift in your net margin, expect maybe to get another turn on EBITDA, which can certainly add up.
Okay, great. Arvid asks, are you seeing in the agency space acquisitions that are regional focused as a way to expand or more global plays?
Certainly an interest in regional players. I think the example of Publicis buying Hetmill is a good one. Hetmill started out of Singapore as a kind of like meme pages, like a digital publisher, and quickly launched in Philippines and Malaysia, but eventually kind of built itself into a social agency, heavily creator marketing leaning. So Publicis bought them essentially to have a very strong footprint in Southeast Asia, right? To reach some of these kind of important emerging growth markets and to be relevant in youth culture. I think there are certainly other examples of that we're seeing both on the software and the services side, right? Like talent representation businesses are increasingly looking overseas. UK tends to be a very popular market for US companies looking at expansion and vice versa. But then continental Europe is another exciting jumping off point. And we've seen, activity around key markets like Southwestern Europe or the Nordics or the DACH region. And because Europe is fascinating as a case study, because there's kind of like these, very rich regions with different languages, different cultures, different creators who have established, who are popular in those markets. And so as a result, having a regional brand or a regional player is often the best entry point. So yes, I think we're going to see more of that activity.
Fascinating. Cassandra says, is there concern around software defensibility related to replication by AI? And how are acquirers thinking about that?
Yeah, I think that's on a lot of people's minds right now, especially for legacy SaaS businesses, right? Like if you look at the Salesforce stock ticker, they've been increasingly challenged because there's this expectation that AI is going to make a lot of these off-the-shelf SaaS products that a lot of us have come to rely on less relevant, right? Very quickly, you could build a custom application, either vibe coded or a fraction of the cost of what you'd pay for maybe a traditional enterprise license. And increasingly, the technology can be commoditized. So if you're building a software business, you need to stay ahead of that, right? You need to build things that are unique and proprietary. The differentiator might be your data. It could be features that are difficult for AI to replicate, either in the execution or the way that it's kind of trained on your experience, like you have a unique insight into how to solve this problem. So defensibility is absolutely a big question. It's a much more of a risk than it used to be for software businesses. And yeah, I think founders need to be aware of that.
Absolutely. One thing that always intrigues me is when I speak to investors who often get loads of pitches coming to them, and I'm sure you do as well, is how can founders basically pitch better to attract either investment or opportunities?
Sure.
What are the sort of key variables that they're going to move investors to consider?
Yeah. Well, it depends on the stage, right? So if you are early stage, this is kind of pre-product market fit. You're selling you and your solution. So it's like, I've identified this enormous pain point in the market. I'm uniquely positioned to solve it. and here's why. And so that would be like a pre-seed or a seed stage idea. Once you get into kind of Series A, the expectation is, okay, you found product market fit. You want capital that's going to accelerate your growth. So the further you move along the fundraising cycle, the more expectation is put on execution and your metrics. So Series A and B, they're going to look a lot at your go-to-market strategy, your customer acquisition, long-term value, like lifetime value, the ability for you to continue to retain, grow, and have a repeatable, scalable sales engine. That comes even more under scrutiny in later stage financing rounds. But for founders who are looking to get investment, I would say it starts with knowing who's the right type of investor for you, right? So first of all, like you can do friends and family, you could do angels, you could do kind of you can raise from strategics, venture capital, growth equity. So find the investors that are stage appropriate for you, right? Where you are in the business life cycle. Find the ones that have an understanding of your industry, right? Investors tend to specialize, right? They want some sort of information advantage, which comes from their knowledge of a market, ability to spot trends and make good investments early. So spend your time like doing your research and getting on those people's radar, get warm introductions, build kind of in public, like share what you're doing on LinkedIn, so that, a lot of early investors want to invest in lines, not dots. So they want to see like your growth and your performance over time. And then just be really tight with your pitch, like make sure your materials are strong, get feedback from other founders and other investors. And then once you go out, make a strong first impression, follow up. And then when you're ready to kind of do the fundraise, have a clear idea of the terms so that you can just make it a very controlled process.
No, great advice. That it really is. And I was going to talk to you a little bit about when organisations are merging,
Yeah.
when it looks like it's an ideal company in terms of synergy. How important do you think the cultural fit is? Because if that isn't aligned, and I've seen some examples, not necessarily in this industry, in others, where that has gone wrong badly, and suddenly the acquired business is a shadow of its former self
Yeah.
because it wasn't managed very well. So I'd just like to get your thoughts on
It's certainly important, and it can be a big challenge, right? It's relevant as part of the selection process. So if you're a founder, you're often going with the business, right? 9 or 10 times, most times you should expect to move on and continue to support the business post transaction. And so it needs to feel like a place that you want to work, right? And that you can have an impact. And your team is going to be supported. So understanding their culture and their expectation for integrating the business is critical. It's also an important part of transaction success, right? I've seen businesses that operated very differently because they were kind of built to perform differently. I'll give you an example. Like there was a company that had a very much enterprise go-to-market motion. It was a SaaS business that was like, we sell to enterprise. It's very hands-on. There's a lot of professional services. It's expensive. The sales cycles are long, but it's worth it because, those are the types of deals that we do. And they ended up acquiring a company that sold more to like SMB and mid-market, which had a very different sales motion, right? It's like, we're still selling software. The price points are lower, but we do a high volume of deals. And so with that, the way we sell, the types of materials, the marketing channels, it just looked very different. And those two organizations had a hard time coming together because, the sales cultures were different, the compensation plan, it was like very hard to make these two businesses speak the same language. And it frankly impacted the integration efforts and the success of that performance. So culture is not just a fluff word or a talking point. It really can matter, both in terms of retention of employees, retention of key customers, and then post-integration success.
You shared with us some really great examples of some wonderful mergers with some of the big agencies. Why do you think they worked well? What were the magic ingredients? Was it the right time? Because I guess the other issue and further question to this is, when is the right time to sell?
Sure. Yeah. It's a deeply personal question, right? So when I tell founders, the way to think about it is there's two dimensions, at least there were for me. One is the business calculus. So how mature is our business performance? What is the state of the market? Are we going to get a strong valuation based on where we're at in our growth cycle? What are the future capital needs of the business? All the considerations around actual company performance and market timing. The second dimension is the personal dimension, right? What do I want? Sometimes founders have been building a business for a long time. It's hard. It's like, okay, we're ready to play the game at the next level, but in order to do that, we need X. Either we need to continue to raise money and invest aggressively. We might need to find a strategic partner who can supercharge our growth. And that personal dimension is an important one as well. So when those two things line up, that's when it makes sense to explore a sale. That was certainly the case for us, right? Like both my two co-founders and I, when we were selling Paladin, felt like, okay, the business, we're very fortunate, and a lot of this is just dumb luck and good timing, that our business was growing very well. And then all of a sudden the pandemic hits and the business exploded. It was doing extremely well. And we had a lot of inbound interest and just kind of felt like, all right, there's some signals here that we should explore these conversations. And then on the personal side, it was like, well, one of my co-founders had his third kid and was thinking about like, hey, what do I want to do next? My other co-founder had his first kid and had an idea for another business that he was really passionate about and has ended up going on to start and has done very well. But it's those things of like, life is a factor for all of us too. And it's good to keep that in perspective.
And you can't always plan for that, can you? Because things happen along the process. We can effectively alter. So it sort of leads into my next question about sort of preparation for the M&A process, because often, particularly private equity companies will often be looking for an exit within 4 years or a sale. How you did touch on it in some of your slides. What are the sorts of things that they need to be doing in terms of their preparation? Perhaps you can just double down a bit more on that for me.
Sure. So the most successful founders start planning for their exit a year or two in advance, right? So that's even before you hire someone like me who's going to help you run the process. It's, all right, what are the metrics that we need to be focused on to get the business in shape? What are the potential risk factors in the business we need to address or mitigate? What's the product maturity or the service plan that, is there going to be continuity? Especially for a lot of founders who think about replacing themselves. Hey, I want to get out of the day-to-day. Maybe I need to hire a managing director or COO or someone who can kind of take the reins and allow me to think about the strategic growth and future opportunities of the business. So yes, I tell people start preparing early and often. There's a few ways you can do that. You can have conversations with folks like us who are going to give you some guidance about what to think about, what are the things to be addressing in your business. I think it also comes by building a strong leadership team. It's, you want a bench of talent and you want to show an acquirer, hey, we've got a really capable, full slate of folks who can execute against the opportunity. And so make sure that that they're all pulling in the same direction. You're hitting your metrics. And then a lot of that just organization, right? The corporate hygiene and housekeeping items that are important to get organized as well.
That's great advice. I mean, what's some of the common mistakes that, with given your time, and I'm sure you've seen lots. What are the sort of standout things, as a bit of a red flag?
Sure. There's a lot. I can share some of what I made personally, and then maybe some of the ones that we've seen. One of the things that I struggle with, I think this is kind of a natural instinct for founders, is you want to. A lot of us are like in sales mode and we're like happy to talk about all the amazing things going on in the business. Hey, this is the growth. This is the new customer. This is, the shiny new exciting product feature we built. And there's this inclination to shy away from the things that maybe aren't going so well or your business needs to address. And in reality, I found it's actually better to just be very upfront with those things, right? It's almost like
be transparent. Yeah.
Not only that, but almost tell the buyer, hey, here's why you might not want to buy my business, right? Like before we spend 9 months and all this time and money with lawyers and et cetera getting involved, let's make sure it's really the right fit. because you just don't want anything that's going to scare them off down the road. And the things that I was most worried about when it came to our transaction, by the time we finally got around to telling the buyer about it, because they're going to find out, right? They're going to look at every inch of your business. They're going to know. They're going to ask questions you never thought to explore. They're going to, just everything's going to come out eventually. They were like, "Oh yeah, that's no big deal," right? And I was like, "Why was I so worried about that?" So better to be upfront. That's one of the learnings. And then another one is, I think there's also this instinct as founders to want to do a lot of things yourself, right? Like you're probably your role as a founder is to tackle the hardest problem in your business and then resolve it. Either you hire for that, you automate it away, you address the challenge, and then you go tackle the next biggest challenge in your business. Like you're constantly giving your job away. And so with that, you get really good at doing new things for the first time. You have this kind of attitude and skill set that lends itself to like, oh, hey, I'll do it myself, right? Like very empowered, which is an amazing skill set and attitude to have. But when it comes to M&A, the most important thing you can do throughout the process is continue to grow your business, right? Like keep your eye on growth. There will be a lot of demands on your time in terms of responding to requests. Don't take it all on yourself. Like, leverage your senior team to help you and keep your focus on executing against your mission, because worst case, the transaction doesn't happen. That's okay. Like you're insulated. You've still built a great business. You're on plan. Best case, you outperform and all of a sudden you're going to get a better deal because you can demonstrate to the buyer that you're executing. And so that's where having a really good deal team comes into place, like a trusted M&A advisor, good lawyers, good financial advisors, because that frees you up. You're not in the weeds trying to like figure out some legal question or a detail in your P&L from 3 years ago. You need to like work with those folks, understand the information and make informed decisions. But, don't try to do it all yourself, because executing against the business goals is the most important thing you can do.
Absolutely. Do you ever worry about what I would call personality-driven businesses? In other words, where a founder is a major component on why clients are actually connecting. It's a quite a charismatic character, and all of a sudden you're trying to buy that. He or she wants to move out, and you're thinking, yeah, but everything could fall away after that.
Yeah, it's an important consideration. It can be an enormous advantage in the right business, and it can be a huge risk factor in others. So this comes up a lot in talent-driven businesses, right? If you've got a creator media property, like how does Mr. Beast sell Mr. Beast without him, right?
Exactly. Yeah.
The world revolves around him, and that's okay. Like he's finding ways to kind of extend his audience and his brand capability. But with other creators, if it's like, hey, I want to think about retirement or an M&A opportunity, you need to explore, hey, can we diversify this away from me? And I've seen people do that with bringing in new talent and moving to more of a rotating cast model or whatever. But it's a particular kind of key person risk factor in these talent-driven deals. It can also be the case in businesses where the charismatic founder is a big part of, I don't know, the marketing, right? Like they're bringing in the leads, and so the demand gen relies on them. Now, there are ways to solve for this, right? You can incentivize that person to stick around. You design a structure that helps protect against the risk, and then also incentivizes the team to perform against it. But it's absolutely something that is going to come up if it's present.
Yeah, interesting. I mean, so what do you find are some of the pros and cons of founder buyouts in your experience?
So most of the time, when a founder does an acquisition, even if they're completely off the cap table, there's still a reason for them to continue in the business, right? And oftentimes the buyer wants that because they want continuity of leadership. The founder is probably still an important contributor to the business, and there's a lot of like expertise that can be gained from keeping them involved. And so that will be kind of the expectation in many cases, is they want the founder to stick around. In fact, if the founder plans to completely exit, you should expect to receive a lower valuation. In many cases, it's not always the case, but in many cases it is. And so, but there's other reasons why it might make sense for you as a founder to do that. Like in my journey, I wanted the experience of working in a larger company. It was like, hey, I've worked in a lot of early stage startups and small people teams, but kind of overnight, I went to working in a team of over 1,200, and our parent company was like 6,000 people. And it's like, okay, this is a very different environment, and maybe there's things about it I'm going to learn from, and there's things about it I'll enjoy, and it was kind of like the next challenge. That was fun. The other thing that I thought a lot about is, as we went through the process, success for me was not, what happened on whatever it was, April 1st, 2022. It was, yes, it's a big financial event. It's life-changing in many cases, and that's incredible. But it was more than just returning, a great outcome for our shareholders. It was about, does this acquisition land well for our customers, for our team, and for the buyer? And so that meant, well, I want to be here because I want to help deliver against that success. I want to measure the outcome a year later, 2 years, 10 years later, right? Like having that longevity of outcome and a legacy of, making sure it was successful. And it was really rewarding for me to we crushed our first year targets at Brandwatch. It was exciting. It was like we had built this product that solved a problem that a lot of Brandwatch customers had, and we had a huge sales team that was able to kind of share the word much more effectively, and it was really fun to see that happen. So it's different for every founder, but those are some of the things that I thought a lot about and got me excited as we went through it.
Yeah, great, fantastic. And what do you think helps when it comes to valuation? What do you think drives a premium into that per
Yeah,
se?
sure. So there's a few things. Some are financial, right? So it can be, what is your growth rate? What are your unit economics? If you've got something uniquely valuable in terms of generating future returns, that's going to be rewarded. The other is, do you have some sort of very unique strategic assets? That can be data, patents, technology, or other sort of capabilities, brands, speed to market, whatever it is. The next area is value to the buyer, right? Sometimes there are things that are just inherently more valuable to one buyer than another, because, hey, we want to keep it away from a competitor, or we know that trying to build this ourselves and shipping it a year later is going to cost us X in opportunity cost. And so we're willing to pay more now to have that capability and execute against that opportunity faster. So there's a lot of things that can influence valuation, but they tend to be financial, capability driven, or buyer specific imperatives that you can play to.
In some of your slides, I was really fascinating to see where the most activity was clearly in North America, and I noticed in Africa it's got a big zero there. And I just wondered about, whilst we know that North America and Northern Europe are still the powerhouses for the creator economy because it's
Yeah.
growing so big. Are we likely to see these emerging countries of particularly Brazil, South America,
Mhm.
and maybe even in particularly South Africa, start
Yeah.
to be real potential hotbeds for acquisition and merger?
I think so, and I certainly hope so, right? And first, I should maybe put a disclaimer that I'm in Los Angeles. I read a lot of U.S. centric and probably Western press. We have the benefit of like SEC filings for public company activity, and so some of this might just be a data collection issue. We try to get as much global volume as we can. I want to know about every transaction that happens in the creator economy, regardless of where it is. I would love to see more transactions coming out of Africa and South America and other parts of the world. But part of it might just be we haven't seen those. And so I'm always encouraging people like, hey, if I miss something, please send it my way. And we're constantly trying to expand our network to founders and creator economy leaders in those parts of the world where, maybe we don't have as much visibility into the activity. Aside from that, I do think it is sometimes a maturity of market situation. And sometimes people say, well, the US market is kind of leading. And then, maybe the Europe is a year or two behind, and then Asia's 2 or 3 years behind that. I think at the rate that technology and information moves now, those windows are collapsing, and we're also seeing innovation happening, not just in Silicon Valley or LA, New York. It's happening in London, it's happening in Mumbai, it's happening in Singapore. It's truly a global phenomenon. And so eventually I think this goes away, but given the concentration of creator economy activity, capital, founders, North America still leads. But I personally love seeing more activity from other parts of the world, and so I'm hopeful we'll see that continue to grow.
And I think the other thing, just to sort of finish really,
Mhm.
is the explosion of social commerce,
Yeah.
and particularly where Asia is right now. And I could see that developing more. So influencer marketing platforms and agencies start to realize that there are social commerce experts out there that so that you've got this entire ecosystem.
Yeah.
Do you see what I mean? Do you see that
I
the
completely
whole
agree.
live stream? Yeah.
Yeah, well, I think that's an area in which China specifically, but Asia more broadly leads. It's largely an
100%.
innovation that's come out of that part of the world, and the U.S. is desperately trying to catch up. Right, big
Mm,
platforms like TikTok and Instagram and Facebook are pushing there. You've got amazing startups being built around live commerce, social commerce here in the U.S. and in Europe. Um, for whatever reason, maybe it's cultural dynamics, shopping behaviors, whatever. It's a slower uptake in the West, but it certainly seems like a growing area, and we take our cues from China in many cases. So
mm.
exciting to see how that plays out.
100%. James, it's been an absolute pleasure having you with us today, and I know you've got some great insights with your own report. We're of course really delighted to have you as our M&A expert within influencer strategist as well. So members can ask you specific questions within
Please.
the community platform as well,
Mhm.
because we've got a special space for this. I think, Sebastian, you're just going to put up a slide about some things and events that we've got coming up next. I think, is that coming up? He says, hopefully.
Very cool.
But no, we've got some really exciting events that are coming up, and if you're not currently a member of Influencer Strategists, do head over and find out some of the amazing experiences and events that we've got going on, and meet pretty much 200 influencer marketing experts there. So
Awesome.
anyway, thank you so much, James, again, and thank you everybody for joining us today, wherever you are in the world, and keep a note out for the next influencer marketing events.
Thank you.
Thanks very much.